Hello, and welcome back to the channel. I'm Algabot, and this is where we break down automated trading strategies for MetaTrader 5, one idea at a time. Today we're exploring an expert advisor called Renko Trend Exhaustion Reversal, built for the US 500 index on the 1-hour chart. It combines Renko brick charting with a measure of historical volatility to spot moments when a directional run may be running out of steam. By the end of this video, you'll understand exactly how it reads the market and manages each trade. Remember, this is educational information only and not financial advice. So what exactly does this expert advisor do? Renko Trend Exhaustion Reversal is a counter-trend, or fade, strategy designed for the US 500 index on the 1-hour time frame. Instead of reading ordinary time-based candles, it builds Renko bricks. A Renko brick is only added once price has moved a fixed distance, so time and small wiggles are stripped away and only meaningful movement is recorded. The size of each brick is not fixed by hand. It is set to a multiple of the average true range, so the bricks automatically grow in busy markets and shrink in calmer ones. Alongside the bricks, the strategy measures historical volatility. It does this by taking the log returns of recent closes, calculating their standard deviation, and annualizing the result. It then compares that reading to its own rolling median. When current volatility sits below that median, the market is described as compressed, meaning the tape is quieter than its own recent norm. The core idea brings these two pieces together. When price has produced a long, one-directional run of bricks while volatility is compressed, the strategy treats that run as potentially exhausted, and it looks to fade it, positioning for a move back the other way. Who might study a strategy like this? It's aimed at traders who are curious about volatility analysis, mean reversion concepts, and alternative charting methods like Renko. It is fully rule-based, so every decision is defined in code rather than left to emotion. As always, this is shared purely for education. Trading the index, like any market, carries real risk, and losing trades are a normal part of any approach. Nothing here is a recommendation to trade or a promise of any particular outcome. Let's walk through the mechanics step by step. On every completed bar, the expert advisor updates three things: the Renko bricks, the historical volatility reading, and the count of how many bricks in a row have pointed the same way. First, the bricks. The strategy recomputes the brick size as the BrickATR multiplier times the current average true range. Then it checks the latest close. If the close has advanced far enough above the last brick boundary, it adds one or more up bricks. If it has fallen far enough below, it adds down bricks. Because it works greedily, a single large bar can produce several bricks at once. Every brick direction is stored in a list, and the strategy measures the tail run, that is, how many of the most recent bricks share the same direction. Second, volatility. The strategy computes historical volatility from the recent log returns and adds it to a rolling history. Once it has enough readings, it compares the latest value to the rolling median. If the latest reading is below the median, the compression condition is satisfied. Now the entry logic. Two conditions must line up. The run of same direction bricks must reach at least the minimum bricks setting, which defaults to 5, and volatility must be compressed at the same time. If the recent bricks are all pointing up and both conditions are met, the strategy reads the up move as exhausted and prepares a short. If the recent bricks are all pointing down and both conditions are met, it reads the down move as exhausted and prepares a long. In other words, it fades the tired move into a quiet tape. The expert advisor also allows only one open position at a time, so it will not stack trades on the same signal. Finally, risk management. For a short, the stop loss is placed one brick above the last up brick top, plus a small buffer of a quarter of the average true range. For a long, the stop is placed one brick below the last down brick bottom, minus that same buffer. The distance from entry to stop becomes the risk. The take profit is then set at the reward ratio times that risk. With the default reward ratio of 2, the target sits twice as far from entry as the stop. Both the stop and target are attached when the order is placed, so each trade has its exit defined from the start. Here's the heart of the strategy as it appears in MetaEditor. At the top are the input parameters you can adjust in the strategy tester. BrickATR multiplier and HvPeriod together set the Renko brick size. Minimum bricks defines how long a run must be before it counts as exhaustion, defaulting to 5. HvPeriod controls the look-back for volatility and its rolling median. Reward ratio sets the take profit as a multiple of risk, and there's also the lot size and the magic number that tags this strategy's trades. Below the inputs, you can see the decision. A Boolean called compressed is true when current volatility is below its rolling median. Then two conditions are built. Short exhaustion is true when the tail direction is up, the run length is at least minimum bricks, and the market is compressed. Long exhaustion is the mirror image, when the tail direction is down with the same run and compression requirement. If short exhaustion is met, the code reads the current bid as the entry, sets the stop 1 brick above the last up brick high plus a quarter ATR buffer, measures the risk, and calculates the take profit below entry at the reward ratio times that risk. It then calls trade.sell with the lots, stop, and target. If instead long exhaustion is met, it reads the ask as the entry, places the stop 1 brick below the last down brick low minus the buffer, measures risk, and sets the take profit above entry. It then calls trade.buy with the same structure. Notice both sides guard against a non-positive risk before sending, so a malformed setup is simply skipped. Let's bring it all together on this illustration. Along the bottom, you can see the historical volatility panel, with a dashed line marking its rolling median. When the volatility line drops below that median, into the shaded compression band, the tape is quieter than its own recent norm. Watch how that panel works together with the price action above. We begin on the left with a steady slide lower. The first several candles, each close beneath the one before, and in Renko terms this is producing a run of down bricks, one after another, all pointing the same way. As the market grinds down, notice the volatility line in the lower panel is easing off and sliding underneath its rolling median. So two things are happening at once. The down run is getting long, and volatility is compressing. By around the fifth candle, the run has reached the minimum brick count of 5, while volatility sits inside the compression band. That's the exact combination the strategy waits for. It reads the down move as exhausted, and rather than chasing it lower, it fades it. The buy entry marker appears as price steadies and prints a fresh low that fails to extend. The stop loss is tucked just below that last down brick bottom, with a small volatility buffer beneath it, so the risk is clearly defined from the outset. Now follow the move that develops. Price lifts off the low and begins to climb. The next couple of candles close higher, unwinding the earlier decline. Because the take profit was set at the reward ratio of 2 times the measured risk, the target sits twice as far from entry as the stop. Price works its way up to that take profit marker, and the long trade is complete. That's the mean reversion idea in action, a stretched, quiet down run snapping back the other way. From here the market keeps rising, and this is where the second, opposite setup builds. Candle after candle now closes higher, stacking up a run of up bricks. Just like before, the volatility panel is important. As the advance matures, the volatility line rolls over and dips back below its rolling median into the compression band once more. The rally is extended, and the tape has gone quiet again. Around the 12th candle, the up run has reached the minimum brick count while volatility is compressed. The strategy now treats the up move as exhausted. This time it fades to the downside, and the sell entry marker appears near the top of that push, just as the last strong candle stalls. The stop loss is placed just above the last up brick top, again with that quarter ATR buffer, so the risk on the short is defined in exactly the same disciplined way. Watch the final candles. Price rolls over from the highs and begins to fall. The move retraces the last part of the rally, candle by candle, until it reaches the take profit marker below. With the reward ratio of 2, that target again sits twice the risk distance away from entry, and the short trade closes at its objective. So across this single illustration, you've seen both halves of the strategy. On the long side, an exhausted down run during compression is faded upward. On the short side, an exhausted up run during compression is faded downward. In both cases, the same 3 ingredients had to appear together. A run of at least 5 same-direction bricks, historical volatility sitting below its rolling median, and no other position already open. And in both cases, the stop and target were defined the moment the trade was placed. Of course, a clean illustration like this shows the idea at its best. In real markets, runs can extend further than expected, and a faded move can keep going, which is why every trade carries the predefined stop. This is a teaching example, not a claim about how often it works. And that brings us to the end of our look at Renko Trend Exhaustion Reversal. We covered how the expert advisor builds Renko bricks from the average true range, how it measures historical volatility and defines compression against a rolling median, how it fades exhausted directional runs into quiet markets, and how it sets its stop loss and take profit around a defined reward ratio. Remember that everything here is educational information only and not financial advice, a recommendation, or a solicitation to trade. Every strategy, including this one, will produce losing trades, and no approach removes the risk that comes with the markets. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like us to explore next, and subscribe for more MT5 strategy analyses. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.